Hello, and thank you for your interest in global investing and in particular for your interest in our RS Global franchise. I'm Paul Pacinic. I'm responsible for the institutional business here at Victory Capital. And what we're going to talk about today is the concept of trust and verify. We're going to talk about engaging human insight to make the most of what is available in the potential of quantitative investing. What we're really going to talk about is TMI. There's too much information available to us, and I think it's something that we'll all agree on, whether it be in our personal lives, whether it be in our professional lives, and certainly in the world of asset management. There's a lot of information to factor in as you look to make the right decision and look to avoid the wrong one. As individuals, what we do to process this information is we engage technology. One of the things that we have with us every minute of every day is our smartphone. And one of the things that we've all heard is that the smartphone has more processing power than was available to all of NASA when they did the first manned moon mission, Apollo 11. It's actually 100,000 times more processing power. Now, as professional money managers, we have many, many multiples of that power available to us in the systems that we use. And we have many multiples of the information that we had available 5 or 10 years ago that we need to deal with. It isn't just information that's reported by companies as part of their public requirements, quarterly information and interquarter updates, sector information, trend information, geopolitics, industry updates. There's a lot available for us that we need to factor in as we make equity decisions. So what we have done and what RS Global has done is we have built powerful models to take in that information, assess it, organize it, categorize it, rank it, and make it available for decision making. And one of the important things that the RS Global team has learned is that you can't just trust the information, you can't just trust the data, you can't just trust the machines. You need to verify. In particular, you need to verify accounting information, and there are other informations that need to be verified to make the very best decisions possible. That's what we're going to talk about today. 3 of the members of the RS Global team are going to join us virtually. U-Wen Kok, the Chief Investment Officer of RS Global, is going to give us some facts and figures on why quant investing is so popular. She's also going to talk about some of the pitfalls of a lot of managers chasing the same signal. Mac Reichel will then give us a few accounting examples where machines don't do well at incorporating nuance into standard GAAP numbers. I think they'll surprise you. And then Adam Mazin has done some work on the 3 major rating agencies and how they factor in environmental, social, and governance into their ratings of the sustainability of different public companies. So that's what we have teed up for you. We hope you enjoy it. With nothing further, U-Wen.
Compared to what life was like as an investor 30 years ago, it has changed a lot. I used to use a lot of technology in my work, and I used to build a lot of financial models. They were all done in terms of dot matrix printers, and very difficult in terms of actually piecing all the financial statements together. It was very highly inefficient. But now you fast forward 30 years, we see that technology has really fallen in costs. Computing power's cost, used to be about $3,000 in current currency today. But you can walk into Best Buy easily, buy a pretty decent computer for about $300. Storage cost in the 1980s used to be about $500,000 per gigabyte, and now less than 3 cents a day. So technology cost has really fallen since the old days. In addition to that, data has, as our friend Paul here has put, data is everywhere. It's abundance. On a single day, you can get 306 billion emails, anticipated to go to 350 billion by 2023, according to the internet. 500 million tweets, 5 billion videos that are being viewed in YouTube, and 4 billion searches in Google. All these numbers, they sound like jargon, but if you use computing power and you use this data, you can really garner some very interesting insights. They might call them unstructured data, but it's still insights. And then you sort of put that all together and you look at what's happening in our industry. Well, the demand for cost-effective, sustainable products has really been increasing rapidly. And here I'm referring to ETFs, smart beta products, passive investing. And of course, this has been brought on by the fact that more than 90% of active managers have failed to beat their benchmarks over the longer term. And they often fail to earn the higher fees they charge. And so the lower cost of data, the lower cost of technology, the abundance of data has allowed academics and sophisticated investors like ourselves to test and find insights and anomalies which could positively impact stock returns. So in our books, using technology and data in investing today can really help get you these data insights efficiently, and it's going to remain here with us to stay and for the foreseeable future. So in order to remain competitive and to retain a considerable advantage over your peers, you should really use technology and data in your investing. Using quantitative methods for global investing in our books is really not an option, but a necessity. When you kind of look at our universe, we have about 330,000 listings, at least 50 countries that we're looking at, and across 6 very broad regions that we track. And if you throw in the metrics that we're looking at, and we've got over 20 years of data, we're talking millions and millions of rows of observation. Without computing power, how can we efficiently cover the best opportunities in the world? And how can we measure these risks that we would be taking when we consider these opportunities? So we really find that quantitative approaches is excellent in terms of finding you the best metrics to be able to employ and seek inefficiencies that will be very predictive in terms of your successful investments in the long term. We also find that you can actually, with these metrics, identify with a certain amount of certainty the best companies. And so once you have those companies, use the humans to interpret the information of these companies. In 2017, MSCI looked at the active managers through the Lipper database. And that was about 25,000 mutual fund managers they looked at. And the data began in 2003. They found something interesting, which is 55% of these managers, in terms of active returns, were getting their returns from having market exposure, market factors, they call it. And the other 45 is idiosyncratic returns. And what is that? Why is that important? Well, because that 55% is really processes, quantitative processes. They're actually all chasing after the same type of information. So we're talking here growth, value, quality, momentum, and all those risk factors that we all are quite familiar with. Now, if everybody is using quantitative processes and chasing after these same pieces of alpha, that means the alpha over time, if it hasn't already, is starting to erode away. So really the only other place to look for more alpha is really on the stock selection side. And the people who are great at the stock selection are, of course, the fundamental managers. So it follows that if we can get the fundamental managers to be a part of this, systematic process, i.e. the quant process that's happening on the other side, on that other 55%, we could capture more alpha. And so don't get me wrong, I don't mean that you can't use any more quantitative processes in the stock selection piece. What I actually mean here is that while more and more quant processes are trying to get to this idiosyncratic pieces, i.e. using AI and machine learning, etc., I think that the answer is a lot simpler than that. We need to start at the very top of the food chain. We need to look at data quality, because these are the inputs that go into the machines. The machine is only going to be as smart as the data. So the best place for an analyst to add value is to help verify, improve the quality of the data, and provide further insights for this information. Today, we're going to talk about two very broadly areas that we like to look at when we are looking at our investing. One, we would say quantifiable, the other is actually non-quantifiable. The quantifiable pieces are actually going to be in the area of accounting, as Paul puts. Mac's going to give us some examples of that. These are the areas that we are going to focus in on, because these are the areas that we find that the models are finding very difficulty in capturing information. We can really add value there. And then the second area will be unquantifiable factors. Here we are lumping ESG in because it's a highly subjective area. And as we all know, it's new. There's hardly any standardization that goes across the board on these topics. And Adam will present that. So with that note, I'm going to pass this on to Mac.
Thank you, U-Wen. So there are many approaches to quant, but for the most part, quant models rely on numbers, and more often than not, they rely on accounting numbers. Now, the problem is that unfortunately, accounting does go wrong, and there are at least 3 areas where those failures need to be corrected and examined. So the first one that I can think of is a very important one. It's the failure of accounting numbers to capture the economic reality of an enterprise. And think about, for example, the importance of intangibles, or think about the numbers of footnotes that now accompany financial statements, and you can see how much extra information is hidden in all sorts of areas. Now, the second important part about accounting is that managers have tremendous amount of latitude. They have tremendous choice when it comes to accounting for their businesses. Therefore, numbers may not be directly comparable unless you can put them on the level playing field. And the third area, which I think is worth mentioning, is that those material events that fall outside of a reporting period are not captured by the numbers. They may well be known to the market, but there is no way to really capture those events in reported numbers. So the solution for us is very simple. We spend a lot of time verifying and validating the numbers, and definitely making sure that we understand the economics of the businesses that we are considering for investing. Now, you can ask yourself a question: is it really necessary? And I think the best way to answer that question is to perhaps look at the example on slide 5. It's a hypothetical example, but it is based on 2 real companies that at some point in time, a few years ago, reported financial statements for a year. And if you look at reported earnings, company A appears to be doing better than company B. As a diligent analyst, one would calculate some performance metrics. Here you have 2, return on equity and return on invested capital. And if you look at the blue bars, on reported numbers, company A appears to be a better company than the company B. Now, on the right-hand side, you have a quick summary of accounting changes that we made to the numbers. And you can see that the attractiveness of these 2 businesses reverses. In other words, company A appears to be doing not as well as the company B, and clearly the ranking in this would reverse, at least for some investors, particularly those who are looking for quality companies, right? So and if you look through some of these numbers, right, they come from many different areas in the financial statements, and are very difficult for computers to really find, just because the source differs, as well as nomenclature may differ from company to company. And this is where I think a human being, a professional, can really add a lot of value by identifying those. So if we move to the next slide. Now, so the example that I just took us through was that of non-recurring items. So there are numerous issues on this, and I'm happy to answer any questions when it comes to this. But there is another area that causes a lot of confusion, and that's mergers and acquisitions, which obviously is a very popular way to grow companies in a number of different sectors. But the problem with M&A and M&A accounting in particular is the fact that two companies which are economically identical may appear very differently on accounting number if one company is built from scratch or built organically, whereas the other is built by acquisition. And the reason is very simple. When you acquire a company, you immediately write up the value of assets. You recognize intangibles which otherwise are not recognized, and on top of this, you have to recognize goodwill. And obviously, that changes the numbers drastically. And maybe the third area, the last area that I wanted to highlight is valuations by multiples. A fundamental analyst has the luxury of building a complicated DCF model with proper assumptions for a very few companies, but for each company under his or her coverage. Quant models really don't have that option, and they rely on investment multiples. But the issue with multiples is that they really obscure the link between the economics of a business and the value of a business. So let's take price to earnings multiple as an example. Obviously, it relies on earnings, but completely ignores assumptions and estimates that were used to come up with those earnings or to estimate those earnings, while at the same time, this multiple completely ignores the capital intensity of the business. And these are really very important factors. $1 of earnings that is generated by a company that doesn't need very much capital is much more valuable than the same dollar earned by a company that requires a great deal of capital. And since we are on the PE ratio, another very important thing that I wanted to mention is that earnings often excludes anticipated write-downs. Now, U-Wen published a paper on this a few years back. I can't remember the year. It has a lot more details, but the whole idea is that some events may be known but are not captured by financial statements. Therefore, validation really is a key way to avoid mistakes. So the message really for me thinking about it is that the numbers without validation not only do not tell the whole story, but worse, they can tell you the wrong story. And with that, I will pass on to Adam.
Thanks, Mac. ESG is a very popular consideration these days when it comes to investing. Many clients are interested and we use it in our process too. Now, it can be implemented in a number of ways, but one of the more popular variations is to use it as a quantitative factor. And we think this is a good way to do it. But like the accounting examples cited that Mac just cited, ESG is another area which can really be enhanced by human insight. Now, the reason we say this is because ESG is still a very new and subjective topic. Providers prioritize different elements of ESG. Ratings can be relative or absolute, and company disclosures are not standardized and can be interpreted very differently by the end user. So if we turn to the next slide, just to give you some color, we compared 3 of the more well-known ESG vendors: MSCI, Sustainalytics, and Robeco. What we found was there wasn't a big overlap between top-rated companies. In fact, if you were to look at the top quintile for each provider, you would find only 13% overlap. That means it is very unlikely you'd find a company ranked highly by all 3 providers. Now, that's pretty shocking. And really, in our mind, it emphasizes the subjectivity involved in these ratings. This means, for the most part, what one vendor considers a very strong ESG company is usually not considered the same by the other vendors. Now, let me give you 2 examples. First, we have a global automaker. According to one vendor, it's a very strong ESG candidate. It ranks near the top of their list. So if you're running a quantitative portfolio and you use this vendor for your ESG factor, there's a good chance it's getting into the fund. However, if you look under the hood, there are some issues which might give you pause. The company has a long way to go to meet 2021 EU emissions targets and is likely to be hit with fines as a result. While this company is not an outlier when it comes to product recalls, it did perform poorly in 2019 and it seems to be moving in the wrong direction. It's certainly something to think about when evaluating the sustainability of this firm. And lastly, the company has been embroiled in a rather nasty public dispute with its home country government, resulting in arrests and substantial negative news press. So for us, this really kind of calls into question its corporate governance rating. Now, to be fair, there are certainly positives for this company, but I think at a minimum, it's best to look at the underlying data, and I think it would be very helpful in this case in making a decision rather than relying purely on the rating. The second example that I wanted to give you is a bit more egregious in my opinion. So we had a look at an emerging market steel provider who again received a very high score from one vendor. However, upon closer inspection, we found a number of strikes against this company that were quite significant. First, corporate governance is weak. The company is run by a controlling shareholder. It's been involved in numerous interrelated party transactions. Neither of this bodes well for a minority shareholder. The company has reported at least one death on site in each of the last 5 years. 5,000 workers staged a bitter 2-day strike last year, demanding better working conditions and better wages. And lastly, just to kind of throw environment into the mix for good measure, the company was fined in its home country for releasing toxic chemicals into the air and water. So it's really because of examples like this that we think it's important to validate the data beneath the factors and even compare ratings across vendors to really improve your ESG outcomes. And with that, I'll pass it back to you, Paul.
Well, we hope that you enjoyed what we were able to share today about how we tackle the challenges and how we chase the opportunities in the global equity market. I've heard these numbers before, but they're still very meaningful and sometimes surprise me. You know, over 300,000 stocks available. That's a lot of good decisions and a lot of landmines. So clearly, engaging quantitative investing to make sense of the information that goes with those names makes a lot of sense. But the fact that there are a lot of managers chasing the same signals can also lead to a lot of crowded trades. The fact that machines, although they can drive a car down the road pretty well, have a hard time incorporating nuance into even basic accounting issues is something that we believe is interesting. And lastly, I was surprised personally when I found that the 3 rating agencies disagreed 7 times as often as they agreed on what was a truly excellent company around sustainability measures. So this is a sampling of the information we have. We've done a lot more work. There's a lot more information available. Our contact information is there. We certainly welcome your calls, your emails. We welcome you to look at our website and see what else is there. Thank you again for your interest in RS Global and Victory Capital.